Welcome to the HumanBOOKS channel, how I stopped treating the stock market like a casino and started building real wealth. For a long time, I thought making money in stocks meant finding the next big winner, timing the perfect entry, watching charts constantly, trying to be smarter than everyone else. I was wrong. Reading How to Make Money in Stocks by Eric Schweizer forced me to confront something uncomfortable. Investing isn't about excitement, it's about structure. It's not about prediction. It's about positioning yourself intelligently inside a system that rewards discipline and punishes ego. This book changed the way I think about risk. It changed how I size positions. It changed how I react to volatility. Most importantly, it shifted my focus from how much can I make to how long can I survive and compound. That shift alone changed everything. I stopped chasing momentum. I started building allocation. I stopped reacting emotionally. I started thinking in decades. The market didn't become easier. I became more stable inside it. And if you listen to this summary, you might discover the same thing I did, that wealth isn't built through intensity, but through consistency. That independence doesn't come from guessing correctly, but from managing risk intelligently. This isn't about getting rich fast. It's about building something that lasts. Let's deep dive in this book. Introduction. The new financial reality. There was a time when a paycheck was enough. You worked, you saved, you retired. That world is gone. Today, inflation eats silently. Savings accounts barely breathe. Wages rarely outpace the cost of living. And crises, financial, geopolitical, systemic, are no longer rare events. They are cycles. This book opens with a direct truth. If you rely only on earned income, you are financially exposed. That realization alone changes everything. The authors position investing not as luxury, but as necessity, not as speculation, but as participation. When you buy a stock, you are not gambling. You are buying ownership and productivity. You are aligning with businesses that create value, solve problems, and generate profit. But the tone is realistic. The stock market is not a charity. It rewards preparation and punishes ignorance. The real promise of this book is not fast money. It is financial intelligence, and that's a very different thing. Financial intelligence means understanding what you actually own, knowing how markets function, managing risk before chasing returns, controlling emotion, thinking long-term while operating intelligently short-term. The book makes something very clear from the beginning. Stocks and ETFs are among the most powerful wealth-building vehicles available, but only if approached correctly. It dismantles the myth that investing is only for professionals. With online brokers, zero-commission trades, and global access to information, the playing field has shifted. Individuals can now participate directly, but access without knowledge is dangerous. So, this journey begins at the foundation, what a stock truly is. And if you truly understand that, everything else starts to make sense. Arc 1. Foundations of Ownership and Market Mechanics include chapters 1 to 5. Before you try to make money in the market, you must understand what you are actually doing. Most beginners skip this stage. They open an app, deposit money, buy something trending, and then blame the market when things go wrong. This book doesn't allow that shortcut. It begins with a deceptively simple question. Chapter 1. What is a stock? A stock is not a ticker symbol. It is not a flashing green or red number. It is ownership. When you buy a stock, you are buying a piece of a company, a legal claim on its assets and earnings. If a company has 1,000 shares and you own 100, you effectively own 10% of that business's economic rights. That sounds empowering, and it is, but the book carefully dismantles several dangerous illusions that beginners carry. Illusion 1. I am the boss. No, you are not. Even if you own shares, you don't walk into headquarters and start giving instructions. Shareholders elect a board of directors. The board hires executives. That's your level of influence. And in most cases, unless you own millions in shares, your power is microscopic. But here's the important insight. Many executives also hold stock. Their compensation often depends on stock performance. That alignment matters. Ownership doesn't give control, it gives participation. That's enough. Illusion 2, I get perks. Owning stock does not mean discounts on products. It means exposure to profit and risk. That's the real exchange. The book uses clear logic here. If companies gave shareholders large discounts, that would reduce profits and ultimately lower the stock price. You'd lose more in value than you'd gain in discounts. This is subtle but important. Investors must think like owners, not customers. Illusion 3. I own the physical assets. Not exactly. The corporation owns its assets. You own shares in the corporation. This distinction protects you legally. If the company goes bankrupt, creditors get paid first. You are last in line. This is harsh, but it's structural reality. Understanding this prevents emotional investing. It reminds you risk is real. Types of stocks: common versus preferred. Common stock gives voting rights and potential dividends. Preferred stock sacrifices voting rights for priority and dividends and liquidation. For long-term investors, common stock is the main arena. But the deeper point is this: know what you are buying. Blind investing is expensive. Technical analysis. Reading the market's language. The book then introduces technical analysis, not as magic, but as a tool. Technical analysis studies price movement and volume patterns. It assumes three things. 1. The market already reflects all known information. 2. Prices move in trends. 3. History tends to repeat itself. These assumptions are controversial, but practical. Charts reflect psychology. Fear and greed repeat. Human nature does not evolve as quickly as technology. Indicators such as moving averages, support resistance levels, momentum oscillators. They don't predict the future. They measure behavior. But here's the realistic layer. Technical analysis has limitations. Markets can behave randomly. Patterns can fail. Signals can become self-fulfilling prophecies when enough traders follow them. The authors subtly encourage balance. Professionals combine technical and fundamental analysis. Retail traders often rely too heavily on one. That's a mistake. Chapter 2. Day Trading, Temptation and Reality. This chapter shifts tone. Day trading sounds glamorous. Buy at 10 a.m., sell at 3 p.m., repeat. In reality, it is one of the most difficult ways to make money. Day trading involves buying and selling within a single trading day. Strategies include A. Scalping, range trading, news-based trading. But here is the brutal truth. Most day traders lose money. Why? Because day trading requires advanced knowledge, high emotional control, significant capital, speed, discipline. It also often involves leverage, borrowed money, which amplifies both gains and losses. The book makes something very clear. You should only day trade with money you can afford to lose. And even then, carefully. Professional day traders have advantages: direct market access, institutional tools, news feeds, analytics software. Retail traders often don't. That gap matters. The underlying message here isn't never day trade. It's don't underestimate it. If you approach the market casually, it will humble you. Chapter 3. Active versus passive investing. Now we shift to a more strategic discussion. Active investing attempts to outperform the market through stock selection and timing. Passive investing tracks an index and holds long-term. Active investing offers flexibility, a potential outperformance, tactical adjustments. But it comes with higher fees, higher risk, lower average success rates. Passive investing offers lower costs, transparency, more, lower tax impact, simplicity. But you will never outperform the market, only match it. Here's the balanced insight. Even hedge funds use passive index funds. That should tell you something. The book doesn't push ideology. It suggests understanding both methods and possibly combining them. That's maturity. Chapter 4. Short-term versus long-term investments. This chapter introduces time as a strategic dimension. Short-term investments include CDs, money market accounts, treasury bills, municipal bonds, P2P lending. They are stable, liquid, but lower return. Long-term investments include stocks, bonds, real estate, ETFs. They require patience and tolerance for volatility. The powerful insight here: compounding works only with time. Long-term investing removes emotional reactions from daily fluctuations. It leverages economic growth over decades. Short-term investing provides flexibility and liquidity. Neither is better. They serve different roles. Intelligent investors use both strategically. Chapter 5, Vocabulary, the language of the market. This chapter may seem basic, but it's foundational. Understanding terms like bull market, bear market, IPO, margin, leverage, volatility, volatility, dividend, sector, short selling, MEG average, gives you literacy, and literacy removes fear. When you understand terminology, the market stops feeling mysterious. It becomes mechanical. And when something becomes mechanical, it becomes manageable. Reflection. The first arc of the book does something essential. It removes illusion. You now understand what ownership really means, why day trading is harder than it looks, read-offs between active and passive strategies, the importance of time horizon, the language of the market. This is intellectual armor, and without armor, you don't survive long in financial markets. Art 2. Entering the market. Intelligently. Include chapters 6 to 9. Understanding what a stock is does not make you an investor. Execution does. And execution without discipline is gambling. This arc transitions from theory into mechanics, how you actually enter the market without sabotaging yourself. Chapter 6. Where to start. First steps into the market. The book begins this section with something simple but powerful. Do not rush. Opening a brokerage account is easy today. Funding it takes minutes. Buying a stock takes seconds. That ease creates danger. Before placing your first trade, you must answer 3 questions. 1. What is my financial goal? 2. What is my time horizon? 3. What level of risk can I tolerate without emotional collapse? Most beginners answer none of these. They start with excitement instead of clarity. The authors emphasize building a foundation. Choose a reputable broker with low fees. Understand the platform. Learn how orders work before placing real money. Avoid leverage early. Avoid complex instruments early. This chapter encourages preparation over action, because once money is involved, emotion enters, and emotion distorts judgment. Chapter 7. Understanding, Orders and Execution. Now we get technical. Many beginners only know one order type, buy. That's not enough. There are several order types that protect you from yourself. Market order. Executes immediately at current market price. Fast, but unpredictable in volatile markets. Limit order. Executes only at a specified price or better. More controlled, more strategic. Stop-loss order. Automatically sells when a stock falls to a certain price. This is discipline automated. The book stresses this heavily. Risk must be controlled before profit is pursued. If you do not define your exit before entering, you are not investing. You are hoping. And hope is not a strategy. Stop limit orders. Trailing stops. These advanced tools allow dynamic protection. But here is the aggressive truth. Many investors refuse to use stop-losses because they believe in the stock. Belief does not stop drawdowns. Risk management does. Position. Sizing, the silent protector. The book introduces one of the most overlooked principles in investing. Never risk too much on a single position. Even if you are confident. Even if the setup looks perfect. Even if this time it's different. A common disciplined approach is risking only a small percentage of capital per trade. Why? Because survival is priority. 1. The market offers endless opportunities if you remain solvent. Aggressive traders often blow up not because they were wrong, but because they were oversized. This is ego again. Smaller position sizes reduce emotional volatility. Lower emotional volatility increases rational thinking. Rational thinking increases long-term survival. Chapter 8. Building Strategy Before Taking Risk. Now the book becomes more mature. Before trading actively, you need a defined strategy, not a vague idea, a written framework. This includes SIA, entry criteria, exit criteria, risk percentage, profit targets, P, time horizon, market conditions. Without a system, every trade becomes emotional. The authors highlight something subtle. Even a mediocre strategy applied consistently often outperforms random decision-making with high intelligence. Consistency builds data. Data builds improvement. Improvement builds edge. But without structure, you cannot improve, because you cannot measure. Chapter 9. When to buy, when to sell. This chapter brings everything together. Buying feels good. Selling feels difficult. Why? Because selling forces a decision. Lock in profit. Accept loss. Admit error. Admit error. Resist greed. The book encourages removing emotion from exit decisions. Sell when your stop loss is triggered, your target is reached, your thesis is invalidated. Market conditions shift structurally. Do not sell because of panic headlines. Do not hold because of stubborn pride. Professional investors accept small losses quickly. Amateurs hold losers and sell winners too early. That pattern destroys accounts. The psychological shift. Arc 2 introduces a key transformation. You stop thinking like a spectator. You start thinking like a risk manager, and that changes everything. Because successful investing is not about predicting perfectly. It is about protecting capital consistently. And now, as we go deeper, we must confront something most people avoid: risk itself. Arc 3, Risk, Costs, and Psychological Reality, include chapters 10 to 11. Making money in stocks is attractive. Losing money in stocks is educational. But understanding risk before you lose money, that's intelligence. This section forces you to look at the market without illusion. Chapter 10, Benefits and Risks of Investments. The book does not romanticize investing. It presents the benefits clearly, but it balances them with structural risks. Let's break it down. The benefits: 1. Tax advantages. Long-term capital gains are often taxed at lower rates than ordinary income. That alone changes the math. When you hold investments over time, you're rewarded not only by compounding, but by taxation efficiency. 2. Steady growth. Historically, equities trend upward over long periods, not in straight lines, not without crashes. But over decades, economic productivity expands. Owning stocks means participating in that expansion. But here is the important distinction. Historical growth does not guarantee smooth growth, and it does not guarantee your emotional ability to tolerate it. The risks. Now we get serious. There are 3 primary categories the book emphasizes. 1. Market risk. This is systemic. It affects almost all stocks: recessions, crashes, wars, global events. When fear enters the market broadly, even strong companies fall. You cannot eliminate market risk, only manage exposure to it. This is why diversification exists. 2. Company risk. Even in a strong market, individual companies can fail. Bad management, debt mismanagement, fraud, industry disruption. Owning a single stock means tying your capital to one leadership team's decisions. That is concentrated risk. 3. Industry risk. Entire sectors can decline. Technology booms and crashes. Energy cycles. Real estate bubbles. If you overexpose yourself to one sector, you amplify vulnerability. Here is the aggressive truth: most people underestimate risk during bull markets. They assume upward movement is normal. They forget that volatility is structural. Risk is not an exception in markets. Risk is the price of participation. The book subtly pushes readers to stop asking, "How much can I make?" and start asking, "How much can I survive losing?" That shift alone separates gamblers from investors. Chapter 11. Costs, Taxes, and Commissions, the Silent Wealth Killers. This chapter is less glamorous, but financially powerful. Because returns are not what you earn, returns are what you keep. Commissions versus fees. Even though modern brokerages advertise zero-commission trades, there are still costs. Spread costs, order execution differences, fund expense ratios, administrative charges. Active trading multiplies these costs. If you trade frequently, fees compound against you. And unlike returns, fees are guaranteed. That's a brutal asymmetry. Capital gains taxes. Short-term gains are taxed higher than long-term gains. This creates a structural advantage for patients. Frequent trading may feel productive, but taxation can erode profits significantly. Long-term investing leverages tax efficiency. Dividend taxes. Dividends are income. Income is taxed. Qualified dividends often receive favorable rates, but you must understand how your jurisdiction treats them. Again, intelligence protects margin. The psychological layer. Here is where Arc 3 becomes deeper. Risk is mathematical, but reaction to risk is emotional. Markets expose psychological weaknesses: greed during rallies, fear during pullbacks, fear during crashes, overconfidence after wins, revenge trading after losses. The book does not over-philosophize this, but the implication is clear. You must master yourself before you master the market. Many investors destroy portfolios not because they lack knowledge, but because they lack discipline under pressure. The market does not reward excitement. It rewards structure. The reality of losses. There will be losses. You will misjudge a company. You will mistime an entry. You will experience drawdowns. The key question is not, can I avoid losses? The key question is, can I keep losses small? Small losses are tuition. Large losses are trauma. The difference is discipline. Arc 3, Reflection. At this stage in the book, something shifts internally. You stop chasing profit. You start respecting exposure. You begin thinking in terms of SECA risk to reward ratio, SECL, capital preservation, SECA tax efficiency, strategic patience. Now you're no longer just learning how to buy. You're learning how not to self-destruct. And that prepares you for something more structured and scalable. Portfolio architecture. Arc 4, ETFs and smart portfolio architecture. Include chapters 12 to 17. If individual stock picking is like selecting players one by one, ETFs are like buying the entire team. And for many investors, that changes everything. Chapter 12. What is an exchange? Traded fund ETF. An ETF is a basket of securities that trades like a stock. Instead of buying one company, you buy exposure to dozens, hundreds, sometimes thousands. This single structural shift solves multiple problems at once. A diversification, simplicity, lower risk concentration, lower time commitment. The book explains that ETFs often track indexes, like the S&P 500, meaning you automatically own proportional slices of the largest companies. That means you stop trying to guess which company will dominate. You participate in the system itself. Why ETFs matter? Here's the practical advantage. If one company inside the ETF collapses, the entire portfolio doesn't implode. Diversification absorbs shock. This doesn't eliminate market risk, but it significantly reduces company-specific risk. That's structural protection. Index fund versus ETF. The book distinguishes between traditional index funds and ETFs. Both track indexes. The difference is flexibility. ETFs trade throughout the day like stocks. Index mutual funds trade at end-of-day price. ETFs offer lower expense ratios, more control over entry-exit, no minimum investment thresholds in many cases. That accessibility democratizes investing. ETF. CHEP trading strategies. Now the book becomes tactical. It outlines several ETF strategies. Dollar cost averaging. Invest fixed amounts regularly. When prices drop, you buy more shares. When prices rise, you buy fewer. This smooths volatility and removes emotional timing. This strategy is simple, but psychologically powerful. It prevents paralysis during downturns. Asset allocation. Not all ETFs are equal. You can allocate across domestic equities, international equities, bonds, commodities. Real estate allocation defines risk exposure. A conservative investor might lean heavier into bonds and defensive sectors. An aggressive investor might overweight equities and growth sectors. The key is alignment with risk tolerance, not imitation of someone else's strategy. Sector rotation, more advanced. Investors move capital between sectors depending on economic cycles. For example, energy during inflationary periods, technology during growth expansions, defensive sectors during downturns. This requires awareness and active monitoring. It is not passive. Hedging and short selling. Some ETFs allow inverse exposure, meaning they rise when markets fall. Used strategically, they protect portfolios during downturns. Used recklessly, they magnify volatility. Again, tools are neutral. Discipline defines outcome. Chapter 13, Creating the Best ETF Portfolio. This chapter transitions from tools to structure. The authors emphasize, portfolio building is not about random selection. It requires design. Step 1. Determine allocation. Ask, how old am I? When will I need this money? How much volatility can I emotionally withstand? Younger investors often tolerate higher equity exposure. Retirees typically prioritize income stability. There is no universal perfect allocation, only appropriate allocation. Step 2. Choose the right ETFs. Important evaluation factors include assets under management, liquidity stability, trading volume, expense ratio, tracking error, how closely it follows its index, market position. Large, established ETFs reduce operational risk. Low-cost ETFs maximize retained returns. High tracking error signals, inefficiency. Details matter. Small percentages compound significantly over decades. Step 3. Monitor and rebalance. Portfolios drift. If stocks rally strongly, equity weight increases beyond intended allocation. Rebalancing restores discipline. It forces you to sell some winners and buy underweighted areas. Emotionally difficult, structurally wise. Chapter 14. Benefits and risks of ETFs. Benefits: diversification, lower cost, liquidity, transparency, tax efficiency risks. Market risk still applies. Sector concentration risk. Liquidity risk in smaller ETFs. Structural risk in niche products. The book subtly encourages avoiding overly exotic ETFs unless you deeply understand them. Simplicity outperforms complexity long-term. Chapter 15. ETF taxes. This chapter goes deeper into structure. ETFs are generally more tax-efficient than mutual funds. Because of their creation-redemption mechanism, they often generate fewer capital gains distributions. But dividends and interest still carry tax implications. Qualified versus non-qualified dividends matter. Commodity and futures-based ETFs may carry different tax treatment. Intelligent investing includes tax awareness. Ignoring taxation is voluntary profit erosion. Chapter 16. Choosing the right ETF. The book outlines practical selection criteria: fund size, FI, liquidity, underlying index quality, expense ratio, stability of sponsor. It even addresses ETF liquidations. What happens if a fund shuts down? This level of detail signals maturity because investing is not only about entry, it's about operational durability. Chapter 17. Costs and expenses of ETFs. Expense ratios may seem small, W5%, 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 W30 years, but compounded over 20-30 years, the difference is massive. High expense ratios quietly reduce long-term wealth. This chapter reinforces a theme repeated throughout the book. Small structural decisions create large, long-term outcomes. Arc 4 reflection. At this point, investing stops being chaotic. You understand how ETFs function, how to build diversified portfolios, how to allocate intelligently, how to reduce costs, how taxation impacts net returns. This is not speculation anymore. This is engineering. You are designing exposure instead of chasing momentum. And now we approach the final arc, where everything connects to real life, because investing is not abstract, it is personal. Arc 5, Wealth Building in the Real World. Include chapters 18 to 23. Up to this point, we built structure. Now we build independence. Because investing is not about beating the market. It is about building freedom over time. Chapter 18. Why investing is essential. This chapter makes something clear without drama. Relying solely on earned income is fragile. Inflation reduces purchasing power. Savings accounts often lag behind inflation. Pensions are no longer guaranteed. Economic cycles are inevitable. If you do not invest, your money slowly loses strength. That's not fear. That's arithmetic. The book emphasizes a powerful shift. You must move from labor-based income to capital-based income. When you invest in stocks and ETFs, you are buying into businesses that produce revenue every day, whether you are working or not. That's leverage. But here is the grounded truth. Investing does not replace work overnight. It compounds quietly, and compounding rewards patience more than intensity. Chapter 19. Managing Investments Independently. This chapter addresses a psychological barrier. Many people believe investing requires a financial advisor. It can, but it doesn't have to. With online platforms, educational resources, and transparent ETFs, Individuals can manage their portfolios responsibly, but independence requires responsibility. You must monitor allocations, FARI, rebalance periodically, stay informed, avoid emotional overreaction. Managing investments independently means you cannot blame anyone else. That accountability builds discipline, and discipline builds stability. Chapter 20, Protecting Against Inflation. Inflation is invisible theft. When prices rise, your cash loses purchasing power. Stocks and equity-based ETFs historically outpace inflation over long periods because companies adjust prices, innovate, and grow revenue. Owning productive assets protects against monetary erosion. Cash preserves nominal value. Stocks preserve real value. That distinction matters. During crisis periods, markets may drop, but inflation continues. Long-term investors think in purchasing power, not just account balance. Chapter 21, Starting with Little Money. This chapter removes another common excuse. You do not need large capital to begin. With fractional shares and ETFs, you can start small. What matters more than starting size is consistency. Investing small amounts regularly builds habit. Habit builds discipline. Discipline builds capital. Waiting to have enough often delays investing indefinitely. Time in the market outweighs timing the market, and time requires starting. Chapter 22, Gradual Investing and Compounding. Here we encounter the most powerful force in finance, compounding. Compounding is not dramatic, it is not fast, it is mathematical. Returns generate returns. Reinvested dividends create exponential growth over decades. The earlier you begin, the stronger compounding becomes. This is not motivational language. It is financial physics. The book stresses patience again. Short-term volatility may discourage you, but long-term consistency transforms portfolios. Compounding rewards. Regular contributions. Reinvestment. Emotional stability. Emotional stability. Long-term thinking. It punishes. Yay. Impulse. Panic. Selling. Yay. Overtrading. Yay. Greed. Chapter 23. Emotional Mastery and Long-Term Discipline. This final chapter is quiet, but crucial. The market tests character. During rallies, greed whispers. During crashes, fear screams. Long-term wealth building requires emotional neutrality. Not excitement, not panic, not obsession. You must learn to detach daily price movement from personal worth. Portfolio value fluctuates. Your strategy should not. The book reinforces that consistency wins. Not brilliance, not luck, not prediction, consistency. And that requires see clear allocation, see quick limits, long-term vision, see quick patience during downturns. Arc 5 Reflection. At the end of this book, something shifts internally. You stop seeing the stock market as a casino. You start seeing it as infrastructure, a system of capital allocation, a participation mechanism in economic productivity, a long-term wealth engine, if used correctly. The book does not promise shortcuts. It does not glorify speculation. It offers structure, and structure creates confidence. HumanBOOKS. Reflective conclusion. How this book changed the way I see money, risk, and independence. When I started studying investing seriously, I thought the market was about prediction, finding the next big stock, timing entries perfectly, outsmarting the system. This book quietly dismantled that illusion. It showed me that making money in stocks is not about brilliance. It's about structure, not about excitement, about discipline, not about speed, about consistency. What changed for me was not how I pick stocks, it was how I think about ownership. When you buy shares, you are buying participation in productivity. When you buy ETFs, you are buying exposure to entire economies. When you manage risk correctly, you are buying longevity. And longevity is the real advantage. This book doesn't promise fast wealth. It teaches financial intelligence. And financial intelligence shifts your focus from chasing profit to preserving capital, from reacting emotionally to acting strategically, from trying to predict G to building systems. The most powerful realization for me was this: wealth accumulation is not dramatic. It is quiet. It is repetitive. It is patient. But over time, it becomes transformative. The market will test you. It will drop when you feel confident. It will rise when you hesitate. It will challenge your ego. If you survive those moments and stay consistent, compounding does the rest. This book gave me something more valuable than a stock tip. It gave me clarity about how money actually grows. And once you understand that, investing stops being intimidating. It becomes structured. It becomes rational. It becomes a tool, not for speculation, for independence. That's it for today. Summary. If this book gave you clarity, take a moment to reflect before moving on. Real change starts with understanding, not speed. If you want more thoughtful breakdowns like this, subscribe to the channel. Until next time, read deeply, think clearly, and take responsibility for your direction.